All right, so I know Disneyland's not open, but we've been there plenty of times, considering that I've got 4 little boys and, well, 1 little boy and 3 now not so little boys, and we live in the West. So we've gone to Disneyland quite a bit, and this week, like I said, it might not be open, but I felt like I've gone through Mr. Toad's Wild Ride this week in the stock market. It was quite the little drop, and again, as we mentioned last Friday, anything between 0 and 23% can happen without even without skipping a beat. And to this week, we had evidence of that you can move between, no matter how big the gap is between 0 and 23%, we can move really easily up and down within a matter of a day, like we did this week, or 2 or 3. We can move within that range very, very easily. And so that was evidence this week. So now we're going to say, okay, so was this the pullback? Was this the pullback? Or like we mentioned last week, is it just noise? And what are the ramifications of either one? So we're going to look at, okay, how do we go into next week? What do we need to see next week to say, here we go again back on an intermediate run, at least the next leg of this current intermediate run? Or how are we going to know if we are in the ending stages of this intermediate run and we actually are going to get a pullback? And then today's trade idea looks at a stock that has a much better reward risk profile than what we've seen in the last week or a few weeks. That's kind of kept us from doing directional trades in the last so many market outlooks. Now we've got that set up, so we're going to talk about how to trade that. So let's go ahead and get started. Today is Friday, June the 12th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicators. You can see we came down to the 23%, just a smidgen above the 23% level on the S&P 500. We talked about the possibility of that, right, of trading anywhere between 0 and 23. Now, didn't think it would take a day, but a couple of days, 2 or 3, like, again, I've said before, and I've tweeted this out before, the only reason why the gap here is so big between the 0 and 23 level is because the gain has been so big. This ended off this March 23rd low point. Normally a move to the 23% line can take a day or two, and that's it. Because normally it's not so wide of a gap. So keep in mind, it's not the size of the gap, it's just the 0 to 23% level, no matter how big it is, that's very easy to traverse. There's no support or resistance in these areas, typically speaking. You can go up and down, as we saw yesterday and then today. You can go up and down very, very easily in these levels. Now, once you break the 23% level, that's a little bit different story. You notice we haven't gotten back above it here on the Russell 2000, though we are getting light pink shading all across the board, really. Not so much on the NASDAQ composite yet, but on the Dow and on the S&P, the intermediate line has fallen below 80. Now, is it going to do something like this? It's more likely we are going to get something like that. The issue is, however, the NASDAQ composite it has not gotten to the 23% level. It did get to a new lower low earlier today, kind of in the middle of the day while we were in our technical analysis class, trading room there. We did get to a lower low, but not all the way to that 23% level. So again, anywhere in this 0 to 23, we can trade without any qualms, up or down. There's no support or resistance in that area. Once you break the 23, now it will act as a resistance, right? And the 38% will act as a support. And that's just kind of how the nature of retracements work. So until you break the 23, there's no retracement here. Lots of these are 23% levels. If I were to activate this and come over here, you can see that was a 23% level. That wasn't a pullback. It was a 2-day little dip, and we rallied. And then you can see here, we didn't quite get to 23%. The same thing here, didn't quite get to the 23%. Same thing there on an intraday basis, didn't quite get to the 23%. And so far right now, we're not quite getting to the 23%. But that will continue to act as an area that if we ever break through, then we would be on a pullback. Then we would say there's a good chance the intermediate line drops below 50, even if it's just a small dip under 50 like that, where we get a brief time frame of dark pink shading, and by then would be obviously a red line. If we dip to the 38% level, we're going to get a red line. because it's that far. The moving average now is that far above the 38%. Remember, your first area of support on the retracement is the 38% retracement. Strictly speaking about Fibonacci levels, of course, you'd also look at different volume areas too and see, and other support areas to see what else might be there. But this, as we can see in the past, has been a bullish pattern. When you get light pink shading and either a yellow line or right to the moving average, even on the intraday basis, it can be a very bullish pattern, especially kind of when you've started this intermediate run, right? If you go back to some other bullish intermediate runs, you can see how after we came off this 2009 low point, we made a rally, and then there's that little dip, that 23% dip to the moving average, light pink shading, and then we rallied again. Same thing up here. We start the run, we get a little dip, a little light pink shading. No yellow line here, but light pink shading, and we continue to rally. You can see one here up, once we start, a little light pink shading for a day, and then we're back up and going again. Lots of examples of that. Here's one over here. We got the yellow line without getting the light pink shading. Came very, very close to it. Over here you can see, we got going. We got light pink shading here with a yellow line, and then took off for the rest of the rally. So another one here, we got going, light pink shading, no yellow line, but light pink shading, and took off for the rest of the rally. So are we going to get that here? Light pink shading after a day, and then we take off for the rest of the rally. That remains to be seen. At least we followed up yesterday's candle with a big inside day candlestick, at this 23% level. So there's a good possibility. The one little red flag that would suggest we might get a little bit more, not like a huge sell-off, mind you, but just an actual pullback. Because remember, this is not an actual pullback. Just like this. I mean, you look at that move back then, you think, oh, that's a big down day, and we've been going up. The reality is, I mean, even if I were to activate this and go over here, we actually hit the 38%. I mean, that would be more of a retracement. We actually did hit the 38% retracement level on that one, hit that support, held it, and bounced off of it. But even this level that we talked about before in the NASDAQ, just 23% retracement. That is not, and there's another 23% retracement. You look back at these now, and they're not pullbacks. They're drops, they're dips, they're near-term dips where the blue line dips below 50. The blue line dipped below 50 a little bit more there. But nothing more than that. You can see here we actually did get dark pink shading again. So that's, that, and we were still in a red line situation at that point. So that's what made that little 38% dip a little different, because we were still in the bearish move actually by then. So as I move this back up to where we were, just remember here, 23% level, it's not a pullback, right? It's just a little bit of a dip. And so when you do get these near term, like if you look at some of these other levels that we talked about before, where you get the light pink shading coming up off of these lows, you can see we did get a little bit of a dip in the near term line here, and same thing over here, a little bit of a dip in the near term line, and the momentum line fell to an extreme. Same thing, didn't quite get the dip there on the near term line to cause that light pink shading. You come over to some of these other levels. The near-term line did not dip to a strong low point there. So kind of a sign that, there's a good chance that these will bounce. That one didn't really dip to a strong low either. The momentum line did dip. It almost looks like the kind of pattern we see here. You look over here, again, near-term line. This one actually does kind of look a little bit like what we saw, what we're seeing right now. Very strong short-term drop. And what we had here was a... excuse me. There we go, up to the high point. I don't even think we got a 23% retracement on that one. Yeah, we did. By the intraday level, we did. Basically like what we got right now. So this is actually a very, very similar pattern to coming off of the 2016 elections. Very similar pattern to what we got now. Very strong move to the upside. We had a pretty decent move. And now we're getting strong short-term sentiment. Like we had that before. We just didn't get the light pink shading here because we didn't stay down long enough. But got the extreme oversold momentum line. Got the strongly oversold near-term line. It's the second time that we've had this. So it's like, that we might be... this might have been the first light pink shading that we just never got. and then we bounced off of that. And this might be the second one that might be closer to the end than it is the beginning of this intermediate run. Because it's not good. It's not a good sign for bullish trends. This whole bullish trend here, we got the little toe dip on the near-term line on the first pink shading, a little toe dip on the second pink shading, and that was it. Nothing else on the near-term line even came close. Over here, you've got really strong short-term sentiment. Another strong dip on the near-term line. You can see how long that lasted as a result. On this blue run, this light pink shading had a strong dip on the near-term line. This one had a strong dip on the short-term line. Nothing else even close, and we only had about another month before we got the intermediate pullback there. So, is this the second one? Is this kind of the second light pink shading area on the market forecast on the near-term basis that would again signify that we might be closer to the end of this intermediate run than the beginning? Now, when I say the end of the intermediate run, I don't mean, oh no, we're going back to retest the March low points. No, not even close. It would just mean that we would come down to the 38%. We'd get a red line eventually. And who knows how long it lasts. It didn't last that long over here, right? So get a red line, get dark pink shading. It doesn't have to go too far below 50, but get the green line below 50. Then we get a rally. Then we get a new intermediate run that typically lasts 1 to 3 months. Market sentiment's rising. It's above 60. So any dip we get, it would be a bullish bull market dip, right? It would just be a pullback, a bull market pullback to support. You would look for support in this 38% area, right around the 283. And as you can see with the Bollinger Bands, that would be the bottom of this volume node. So you'd be kind of at the bottom of the node there, trading around the node, probably filling in some volume, but really making a big thing here. So when you break back up above it and you get back above the 23% level, which is now where the point of control is, away we go to the upside, right? That would be a very, very good sign for the markets going forward. All right. So that's kind of the expectation on the market forecast. You can see some of the other oscillators like the RSI stayed above 50. The CCI stayed above negative 100 by the end of the day. You look at the DMI, the negative index did get above 30, but the positive stayed above 25. So very easy for this to pop at, similar to this, right, where you had the negative popped up, but the positive didn't pop down too far. We had a very similar pattern over here as well. You can see it's very easy to stay positive. It's okay for the negative to pop up, but as long as the positive stays up too, it can bounce right back up and be right back at strong bullish levels. Again, we saw a very similar pattern right here that we're seeing here, and for that matter also right over here. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below this video if you're watching us on YouTube. Also, that will notify you when these videos are posted. Also, down below the video, there's a thumbs up icon. Click on that icon. That tells us two things. You liked our video and you want us to do it again on Monday. It's a quick way to give us feedback. If you like our videos, let us know, and you can do it with one click right now while you're watching. If you don't like our videos, then you don't have to click on anything. Also, too, comment. What questions or comments do you have about anything we discussed in the video tonight? You can post down in the comment section below. Join our website at marketscholars.com. There's a link popping out right there in the top right corner of your screen. Click on that link. It takes you to a page where you can subscribe to our site for free. Follow me on Twitter for more content between videos from day to day at DavidSettle42. And also join our Market Outlook Facebook group that we've created. All right, if you're watching our page here on our blog, the video on our blog, check out our Market Outlook live video. You can click here to watch. That's where we review all of our old Market Outlook trade ideas, as well as we put on today's trade already. It's already actually pretty moved in a matter of like 15-20 minutes, and the market closed and moved. And that's why we do that, right? That's why we put these trades on now, so we don't have to wait till the next day's open. In this case, Monday's open. Of course, it can work in both directions. But check that out there. There's also our upcoming class schedule. Remember, our monthly subscribers here, our monthly plus subscribers, get access to those live trade review videos as well as all of our trading rooms. Our Q&A sessions, as you can see, mine's coming up tomorrow morning, as well as other premium tools and charts and resources are available for our premium clients. They also get the trading rooms and the live trade review videos too. Engage with us here on social media. Click this heart right there. That opens up a new window, and hit that like button. That lets us know that you like today's market outlook as well. Hit the thumbs up. Do the same thing on Facebook. Again, that benefits us because the more these posts have, the more likes these posts have, the more Twitter and Facebook will promote our content to all of our followers on our accounts. It benefits you because Twitter and Facebook promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us here. All right, let's get back to the charts now. Let's take a look at the weekly chart. This is an interesting chart because it was kind of flirty. You can see we're barely at golden crossover. We were flirting with this zero level all day long today. And by the end of the day, we closed with a crossover. So we got a golden crossover on there. We've got the retest so far, at least, of the 200-day moving average. But the Hakinyashi candle is fascinating because we did get a higher high point this week, early in the week, but we did not finish with a higher close. We got a lower close and we got a lower shadow. Those are two kind of, when you're bullish, you can see you want higher highs, higher closes, and no lower shadows. That's typical of a bullish trend. Just because here you got a lower high, a lower close, and a lower shadow. That could have been a reversal, but it wasn't, right? So it doesn't necessarily mean that probably should have been, but it wasn't. You get transitions candles like that. It doesn't have to turn around, but there's a very good chance now next week's candle can be a transition because again, to get a higher high point, we'd have to get above 32.33. We're at 30.41, so we'd have to go up basically 200 plus points next week to get up there. It's not out of the realm of possibility. We had a 250 point range this week, so it's not out of the realm of possibility at all. Next week's open on the Hakinyashi is going to be right around 30.78. We're already trading at 30.41, so we're already going to be below. Even if we end up above the open by the end of the week, we're going to have a lower shadow. So we are guaranteed to have a lower shadow depending upon where we open, of course, on Monday. If we open above 38, I guess we're not guaranteed, or 30.78. But if we open up right around here, then we're going to get a lower shadow, and we're going to get it's going to be hard to get a higher high, and obviously depending upon where we close, that's going to go all the way up to Friday because the close on the Hakinyashi candle is the average of the actual candles open, high, low, and close, 4 different prices. So in other words, we are getting transition candles. Now, we had a few here. We had some lower shadows. We did get slightly higher highs, and we get slightly higher highs as well as slightly higher closes. So these weren't as bad as what we see here and potentially next week. So basically, we need to keep our eyes on next week. These transition candles that look like this, for example, like October the 1st of 2018, you can see some of these others. When they look like that week of October the 1st of 2018, let me show you what it ended up looking like. So right here. So here is, and let's go to a regular candle chart. Here is October the 1st. So 2nd, 3rd, 4th, and 5th. So that's how this is the week that produced that transition. So basically we broke below near-term lows in this case. That the transition candles are they're not actual sideways candles. That's kind of the point I'm trying to make here. When you get a transition candle on a Hakinyashi basis, and you can see the daily charts are showing pretty bearish here. But on a Hakinyashi candle, if we get a sideways candle, kind of this really kind of flat transition, there's another one there, and the end of January, that last week of January, those are pretty down weeks in and of themselves. So if we get one next week, it won't be because we're flat. We'll either bounce up off of this and we don't have to worry about it, or off of this low point, off this 23% line where we're kind of trading close to, or we don't and we break the 23% line again, like we already have on the Russell. See, the Russell has broken the 23% line, so and finished with an engulfing pattern here. We break through that and we flirt more with the 38% level. That support trend line, which also would happen to be the 50% retracement of the decline of these. So 2 Fibonacci lines from 2 different moves kind of lining up with each other. Take off the little channel here we got going on. This one and this one. All right, so now let's take a look at the 3 green arrow charts for the S&P, and came really close to 3 red arrows yesterday, and today too. We actually were flirting with 3 red arrows today. Look at the good volume we've had in the last couple of days, strong volume. There's your 2 red arrows. So this is what it looks like on a 2-line basis. We are right down to that 30-day moving average or below the 17. We have not bounced back up above the 17. So early next week, it's very important that we bounce right back up early, Monday, Tuesday, at the latest Tuesday. Like if we're going to bounce below the 17 and not roll over, we need to bounce right back up. And you see examples of that over here too. Here, let me just make sure we log scale and all right. So if I were to come over here, and do I need to not fit the studies? Is that what's throwing me off here? Hit the same wrong button every time. All right, so let me go to a year chart or 2 years. So remember how I said that we have these 2 light pink opportunities here. So we did dip below the 17. We got right back up above it on that light pink shading, and then on the second light pink shading later in the year. So over here, we got down below the 17-day. We got almost right back up above it. We got down below it again. We got right back above it. We got down below it again. 2 days later, we got right back above it. So, if we're going to light pink shading, if we're going to bounce off this bad boy, and again, just like we did over here, down below the 17, right back up above it. So we're down below it. Now we're still down below it. Monday, I would say Tuesday at the latest, we need to be back above it. And I would venture to guess if we are going to get back above it, we're probably going to get back above the 8-day, which would be a very positive thing too. And that MACD histogram would roll up. Similar to here, MACD histogram would roll up. Stochastics would roll up. And then now we have our, we have at least a green arrow on the stochastics. We have a green arrow on the MACD right there. Actually, right. Yeah, right. This is a negative here. Oh, here it is. Yeah, that's still negative right there. There's where we got the green arrow on the MACD, and of course the green arrow. We never did not get a green arrow on the moving average. So we have a red arrow here. So the first green arrow will most likely come from the stochastics. We'll watch for the histogram to turn up too, maybe at the same time, maybe not. And then again, getting back above the 17, the 8-day, that will be kind of our confirmation that this 23% level is held. Here we go, and we are getting a new leg higher. Now, again, this is our second leg of light pink, quote-unquote light pink shading on the market forecast. So, we might get another month, maybe, out of this run. But this is usually these kind of moves occur towards the end of the intermediate runs when you get the second one, not necessarily towards the beginning. So, just keep in mind, I wouldn't be like backing up the truck and expecting that we'll have like 3 months of nothing but upside here. Maybe a few weeks before that July expiration, which is where we usually peak in the summertime, and then we generally have weakness all the way through basically till earnings season in October starts. The markets are generally weak. That's the wholesale and main go away. The worst of the downside is from July expiration to the beginning of October earnings season, maybe a week and a half before October expiration. Now let's look at the intraday chart, and this has been a fascinating chart too. So we gap down. I mean, this has the look. I mean, here's your 23% line. So far it's held great. And again, like I said, getting above the 17-day and the 8-day and filling back in this gap Monday and Tuesday, okay, right? That's what we want to see. But if we don't, and that has all the makings of a runaway gap, which runaway gaps start intermediate runs, and this would be an intermediate run to the downside. Now, I wouldn't expect it to be too big, and most likely towards a 38% level here. If I zoom this out a little bit more, here, let's go to 30-minute. So most likely to this 38% level, if not maybe down, at worst, I think down to the 62% level. That's where the next layer of support, and there's a good volume node there. But most likely probably into this 280 area is where you'll have some significant strong in between the 38 and 62 in this retracement zone. That's where your point of control is in the last 90 days. So I think that's kind of like the likely scenario. If we don't bounce back above the 17-day and back up above this high point from yesterday and start filling in that gap, like I said, as late as Tuesday. If by Tuesday we're not seeing that, then and we're just kind of trudging around here and maybe even flirting with breaking, like I said, like we've already done on IWM, right? IWM we already have broken down the 23% retracement level of its move off of this low point up to that high. And of course, QQQ is also an important thing to keep an eye on too. It doesn't have the gaps. It's already filled in a lot of these gaps, and it finally filled in the rest of that gap. There's this gap down here it's still got left to fill in, right around 222. And again, when you're trying to find where, here, let me 1 second, snap this really quick. When you're trying to find where there we go, up to this high point up here, so something in that area, then you can see where the 38% level is, and you can see too where the 23% level would be. So that's how much down to the rest of this volume node is how much it can still come down. And then of course it's 38% is where its point of control is, and that's where probably if this were to turn into an intermediate pullback, then you always expect support and resistance to hold until it doesn't. I think there's a good chance that that support would hold across all the different major indexes, S&P, Qs, before we turn around, and then we can bounce and get going again and start a new multi-month intermediate run that can last a while. Again, we'll see how that lines up with the seasonality, but again, we might bounce right off of here until July expiration and then get the 38% retracement, the actual pullback going into October. But again, volatility, you have to keep in mind volatility with the presidential election. If you go back to the last presidential election that we had, so let's go back on the market forecast here, and you're talking about seasonality. Oops, sorry, I keep going to the wrong thing. Let's go 5 years back, and we'll go back to right over here. So here's June, right? So you can see there's volatility in June. Now, granted, that was Brexit here, so that was a little abnormality there. Then we got to July expiration. We were pretty bullish going into July expiration, as seasonally is the case. And then from July expiration to the beginning of earnings season, we were pretty weak. And then, of course, in October, we were really weak because there was a lot of uncertainty around the election, and the markets don't like uncertainty. The markets are apolitical for the most part, but they don't like uncertainty. So the more there is uncertainty regarding the election coming up in November, no matter who you're pulling for, the market doesn't care who you're going to vote for. The market just cares that there is that there is certainty coming out of it. Once we got certainty, the market took off. Until then, it was pretty bearish, and I would expect something like this to occur going into this election. You can see we had come off of a low point in a pretty bearish first part of the year then too. It was mainly in February. You can see by the time we got to, if I were to edit this and throw on the 23% level, by the time we got to the election, we were just barely flirting with the 23% level at that point of that run, not counting these two little drops, but this entire yearly run, we had just barely flirted with that. So it kind of gives you an idea. Even though we weren't sharply bearish, we also weren't bullish anymore. We were just really, from that July expiration right here going forward, really darn sideways, and eventually into September and October, more of a bearish bent. Again, dark pink shading, red lines. Let's take a look at the volume and the trading range. So the volume 194 million. The trading range with the gap filled in was 10.5 points. Yesterday's trading range without the gap being filled in was 12 points in and of itself. So, but the ATR, remember, does account for that. So if you look at the ATR really jumping up pretty high, it's a 14-day average, mind you, but still jumping up pretty high. If I were to change this ATR, to just a 3-day to kind of show you how compressed we were getting. in terms of the range here. So let's go to 3-day here and hit this. This is already at the 3-day, I believe. This is already at the 3-day. So we'll hit OK on that and hit OK here. You can see that we had gotten pretty darn low on a 3-day basis before this little bounce up, and you can see how significant it is. Now if I just go back to the normal ATR, so go back to 14 days on this one. So let's go back to 14 days here, and then go back to 14 days here. So you can see we are back up above the 2% mark on the ATR. So remember, we're not really entrenched in a bullish trend until you're below the 1% mark. So it's just a reminder of just how volatile we remain. Like, again, the 0 to 23% gap is one sign. Here's this another sign. The ATR and the volumes are still very high relative to normal markets. As you can kind of see, let me give you a little bit of context here. Here we are. There are a couple of bounces here and those in 2018, but go through 2017 over to 16, you can see. And remember, this number, if you compare it to the price is higher than it was over here. They're still pretty high in that number, and you can also see too the ATR is very, very high, especially on a relative basis. It is as high now as it ever gets during the bearishness of these past death cross moves. So it's just a reminder, we're not like in slow grind bull market mode here yet. We're still above the 95% mark. We broke above the 95% mark yesterday, and we pulled back today, but we're still above it. So we're still in bearish territory, bullish territory for volatility, bearish for stocks. So let's, you break back below 90 and you stay below 90 instead of just kind of flirting with it like we've been doing. That's when your bullish trend is entrenched. Until then, expect up and down volatility. And considering, again, how big that 0 to 23% gap is, expect some pretty decent sized moves up and down inside of that range until we get a pullback, and more of a sustained pullback that we can bounce off of and then just slow grind our way back up to the upside. All right, so let's take a quick pause just to summarize your outlook. We've had a pullback, we've had a noise, we've had a drop. It's not even a pullback. To a degree, it is on the Russell, but definitely not on the NASDAQ. So it is a drop. It's a drop. It's a noise. It's when you get so far away from the median, from the mean, moving averages, whatever, then you can move back down to it and still not necessarily be a pullback, right? It's just, again, just because of how big the move is to the upside, you're going to have big moves to the downside, especially with volatility as high, ATRs as high, other volatility indicators still pretty darn high. You're going to have big moves. So we have to be able to stomach those moves, and that's why in our class portfolio, we've remained we've had a pretty neutral portfolio. Like over the last couple of days, we're actually up the last couple of days. We were up yesterday a few $100 with the markets down over 5-6%. Because of what we've been talking about in these videos, the nature of the risk rewards. But the nice thing is, like I said on Wednesday, how there's not very many good reward risk profiles out there. Now there's getting to be more and more, and you'll see with today's trade idea, there's going to be more and more, and if we do get more of a pullback, there'll even be better reward risk profiles that will set us up for new bullish directional trades that we haven't had opportunities for a few weeks now because of how bullish we've been. So what do you think? Do you agree with that as technical assessment? Do you disagree? Comment down below, especially if you disagree. Comment down below as to why. What are you seeing that suggests either you're more bullish than I am, or and this is it, and here we go. Like now we can back up the truck, or that you're more bearish. So this is just the tip of the iceberg in terms of how much we can go down. What's driving you to have that? What indicator? What chart are you looking at? And share that with our community down below. All right, really briefly, we're going to go over, since we spent a lot of time looking at the technicals, just kind of the different markets and how they performed here this week. So let's get to just this week alone and take a look at the moves that we saw. Of course, we saw early, the Qs were up, gold was up, and long-term bonds were up really early in the week. So it's kind of interesting to see, preferred stocks. No, it's QQQ was up early in the week, and you can see, small cap stocks were down. They really came down on Wednesday, even though the market still stayed flat. The IWM was down. You can see that real estate was down, the REITs were down, high yield bonds were down, the dollar was really down. But then by the end of the week, dollar rallied. The Qs stayed, outperformed all the other equity asset classes, even though they gave up some of their losses. And you can see they didn't give up too much of their losses compared to IWM. If you look at this relative strength line, this is a weekly chart on the relative strength after this pretty decent pullback last week. The last few weeks on QQQ, we basically recovered the last 2 weeks and then some of that underperformance. You can notice the relative strength line in the weekly chart dipped, but didn't drop below 50. We're already back above 60 on that relative strength line. The MACD itself, the histogram had been coming. The MACD was coming down. The histogram was coming down, but now it's kind of slowed that descent, and the PPO is still easily. Now, granted, I have to go actually to a 10. We'll do 1040, and then this would be 1040. 10 and 40. So if you take a look at the weekly PPO, you can see it had been dipping too from relatively high levels, but again, slowing down that descent. So we'll see. Again, there was a lot of chatter about the change in leadership here at the small caps, and then that just got blown away this week by getting right back up above that 50-day moving average, in this case 10-week exponential moving, or this would be the regular simple moving average. Right, so you can just see, again, that RSI rising. That leadership, that change in leadership has short-lived as the Qs regained. Even before the big drop on Thursday, the Qs were outgaining. Even before the drop on small caps on Wednesday, the Qs were already winning the week going into Wednesday. So it kind of gives you an idea. But it's interesting also to see that bonds are so bullish. Now, if you take a look at the long-term chart for bonds, you can see how we had been pretty bearish. We had a breakdown last week, and then finished this week with a transition candle. Right? That'd be a transition candle. So there's the possibility that we might go up again. Especially if we get an intermediate pullback, probably will go up again on long-term bonds. This is what the regular candle looks like. So a little bit of a bullish engulfing pattern. If we did go up again, keep an eye on a divergence, right? Lower highs, again, for some context and how bullish that is. We've been the 50-day moving average has been 10% above the 200-day moving average a couple of times. In 2008, it was at the end of a strong bear market. In 2011, it was during the credit crisis downgrade, and then we got another leg higher. Now, this took months, but we got another leg higher. Even here, we got another leg up by the end of the year. That could be very similar to what we might get over the next maybe month or two here. Let's see maybe if that seasonal weakness will extend. Remember, June is typically seasonally weak, but we have a pickup to higher highs around the July 4th holiday before we have a couple of months of seasonal weakness. So we might that couple of months might be extended a little bit, not to the extent that we'll really drop down, but that's just something we need to keep an eye on. Again, I don't think any intermediate pullback we get over the summer is going to be earth-shattering. We might just chop around the 38% between the 23 and 38. That's kind of more like the more likely scenario. And because we don't go anywhere, the intermediate line, the moving average roll over, will get dark pink shading on the intermediate line, but it won't necessarily be, maybe the 50%, right? Maybe we'll come down to that level, but that would typically mean a bounce back up. I mean, we're already back up to the 50 on the 200 on gold, on long-term bonds, on gold. You can see the bounce back up here. We already got back up to pretty much as high. We never did get a 23% retracement. And remember, gold is, whereas long-term bonds, if I go linear regression and then I go out to a 10-year chart here. So long-term linear regression, which is pretty significant. If you look at bonds, we're right back up above that 1 standard deviation. Let's go on a weekly chart, so you can see it all in one chart. So we're back above that first standard deviation channel. Gold is back above its second standard deviation channel. So again, just goes to show just how overbought the safety trade is. And eventually, when the markets do leg up higher now for a while, after any weakness, seasonal, intermediate pullback we might get, eventually, whenever it does, then this, not only like we mentioned on Wednesday, on Wednesday we talked about the Fed, and again, watch that discussion. Watch my trading room yesterday on portfolio management. I really broke that down. There's some significant tailwinds for the stock market from fiscal and especially monetary stimulus that can lead us up. The other big tailwind is the safety trade unwind that still hasn't unwound. It's still wound up pretty tight. So the more it unwinds, then that's going to be a tailwind for risk appetite as well. Let's take a quick look at the sector rotation and how it performed here this week. Energy had a good start to the week and finished the week pretty strong. Here's the week that was. We'll start with the week that was. Energy started the week very strong, pulled back down to where it had the biggest loss after Wednesday and Thursday. Big, huge loss. Then, it did it okay today. In fact, you can see if I were to look at here, this watch list of the different sectors. Where are they at? Right there. Energy actually was up at the top, pulled back a little bit. Real estate ended up, but you can see dollar related sectors doing very strongly today. Other interest rate sensitive areas besides real estate, not so much. Real estate really took off. We have a position in our class in a home builder, and it was one of our stocks that did the best today. So real estate's holding up very, very well. But you can see, how energy ended up doing. Look at technology, communication services. So, again, through the ups and the downs, the Qs are going to be our leadership. The only time the Qs are not going to be our leadership is when it takes a break, right? When it oscillates and it goes up and down, when there's a breather in that outperformance, then you'll see financials and industrials come back up. But until yields can get going, financials are going to have a hard time getting going themselves. Yields had a really down week. It had this nice breakout last week. It's almost as if that breakout didn't occur this week. It's still a pretty bullish pattern, so we have a chance to bounce off of this. If we don't, if we have the intermediate pullback, financials are going to struggle. Financials are going to struggle. Industrials are going to struggle. If you look at the 12 grid here for the major sectors, you can see, which ones have come down, which ones are showing light pink shading. Financials, industrials, materials, energy, your safe haven areas, all showing light. In fact, healthcare is showing a red line. So is a staple showing a red line here. So, you're getting some relatively weak signs, but not in your Qs, right? Not in your cyclical, not in your large cap techs, which is what are mainly in these three sectors. They're continuing to be a leadership going forward from here. So for our trade idea of the day, I actually did want to take advantage of the big sell-off in an industrial name that had been doing pretty well, UNP. If you take a look at Union Pacific, it came down yesterday and got us our light pink shading, and the yellow line was actually giving us a yellow line. A lot of this lower shadow actually occurred during our Market Outlook live session today. So it was moving up as we were speaking. In fact, if you take a look at the end of its day on this intraday chart, you can see what it was doing at the end of the day. Here we go. So here's the very last. There's the last 15 minutes. This is a 5-minute chart. This is a 10-minute chart. So there's the last 20 minutes. We had a little bit of a run right up at the end, and this is when we got into the trade as it was starting to move. And so it produced that some of that long. We were flirting with that yellow line again today. That's kind of what jumped out at me. Why the stock jumped out at me, similar to that pattern. Looking for a move like this to come off of this pullback, right? For a bounce to come up. Again, noticing that we did come below the 23%. So we have an opportunity maybe to get a decent sized move to the upside, coming off of an extreme low, a much stronger low point on this side than we did over here. If it doesn't bounce up, I'll show you what the trade that we did. But if you take a look at like the Ichimoku cloud to see, okay, how big was this pullback? We did get below the red line, blue line, excuse me, like we did over here. You expect a potential bounce to occur from that. If you look at the 3 green arrow chart, we did get 3 red arrows yesterday. We got 3 red arrows. We're back. We've got the green arrow back on the moving average. That's always first. When you get 3 red arrows, that's always first. The second would be the stochastic, and then finally the MACD when the blue line crosses back above the orange. So we already got the 1 green arrow back on that. Let's take a look at the long-term chart here. And you can see we had broken up above the 200-day moving average. We pulled back down to the 200-day moving average, so that's acting as a support level. So you can see very similar to the market as a whole. If we bounce here, great. If we don't, then we'll take a small loss. And here's some other signs like the RSI and the CCI. You can see they pulled back, but not below 40, right? They pulled back to levels where we can bounce off of here and get moving back again. Like, for example, over here on the RSI, and the exact same, almost same thing that we had over here on this pullback. So if we get a similar pattern, great. If we don't, then we'll take a small loss on this. And this is the trade that we set up. In fact, we set up 2 different trades. First trade on UMP is we did a long vertical spread. So we sold the 185 and bought the 180. And you can see, it's a relatively wide spread, so you have to kind of fiddle with the price to get filled in on that. And this is what it looks like here. So we ended up getting filled in with 5 contracts for $485 of risk, which is a little less than half my normal risk. And then if you look at where that maximum gain is, there's your maximum gain, just outside of 1 standard deviation to the upside, as volatility kind of came down at the very end of the day. We do have earnings in July. And so that's why volatility is kind of volatile. You can see the move that we had since we got into the trade where we're at right now. And so what we did with the volatility, in order to keep the volatility from turning negative too quickly, is we added this calendar spread, right? This calendar spread, which is a positive Vega trade too, and because earnings is right on expiration, it's like the day or two before. So as we approach 185. Then I can keep my Vega, I can keep it from turning negative as we approach that earnings with the positive. I can take this off the trade as we get closer to expiration. You can see as we get closer to expiration here, you can see what that purple line does. So with volatility rising, I can get out of this trade. If we approach 185, I can close out the calendar and be done with it, and now that's the benefit. Take advantage of its benefit of the rising volatility. Leave this on, which now if we were at 185 in that area, we would have a negative Vega. So if volatility drops, we'd actually be fine, but we'd be closer on maximum gain, and I'd have some gain on my calendar if we got to that point that would help offset anything we might lose if the earnings were to cause a little bit of a sell-off from that point. So we'll see, right? And again, worst case scenario, I have a better than 4, almost 5 to 1 reward to risk ratio here. Better than 4 to 1 reward to risk ratio at the worst case scenario. That's if I can't manage my risk if I can't manage my risk to 50% of this 485. Best case scenario, for a couple $100 of risk, if this were to break down UMP, if it were to break down below 160, then here's 160, then I don't need to be in it anymore. We can just take it either bounces or it won't. And if it doesn't, then we can get out with a couple $100 of loss and be more than happy to take it, knowing the reward potential we have if it does bounce. And that does it for today. So you've heard from me now. Now I want to hear from you. Use that link to go to our Market Outlook forums on our website at marketscholars.com. Open up any new thread, reply to anybody else's thread, and let's keep this conversation going on what we talked about in our video today. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video, follow us on Twitter for more content in between videos, and join our community at marketscholars.com, as well as our Facebook group we've created. Have a great rest of your weekend, everybody, and we'll see you all on Monday.